What's going on, guys? In today's video, we're going to talk about what I think is the best formula to help you screen stocks in a recession. If you hear people talking about what you should do personally in a recession right now, it's make sure you have good income, cut your expenses, get your cash flow up. Well, in my opinion, that same thing holds true for businesses as well. So when you're looking for stocks to buy in a recession, and pretty much any time, to be honest, cash flow is king. And so the formula we're going to talk about today is the free cash flow yield. So the formula for free cash flow yield that we're going to do basically breaks down like this. You take the cash flow that the business generates, which is basically cash flow from operations, and you minus any capital expenditures that they make. The reason you do that is because capital expenditures can be maintenance for property, plant, and equipment to keep the business going. And then once you have your free cash flow to firm, you divide that by the enterprise value. All right, so now that I bored you with a calculation that you don't even know if you care about yet, let me explain why I think it's important. If you're relatively new to investing, the only time you probably hear about the stock market is when there's some new hot stock that just came out and it's gonna be the future of whatever, and everyone's jumping on board. And a lot of times when you hear stocks like that, they're really earlier stage growth companies that people are trying to catch before they become big. And over the last couple years, especially with the pandemic, you've probably heard about a lot of these companies. Peloton, Uber, Snapchat. And usually what a lot of those companies have in common, especially early on, is they're not very profitable. Because they're trying to grow at all costs, they're spending money, they're not really making earnings, and they're not really generating cash. So when you look at what's happened in the market over the past 6 months, even though every stock pretty much has been impacted, the ones that are really high growth and low profits have been impacted the most. And as we head into a recessionary period, I only expect that to continue. So the type of things that I look for, especially times like now, are companies that are high cash generating businesses. Having cash in a recession means you have options. Number one, your business is going to survive, which is the first goal. And then number two, it gives you options on how to best position your business for long-term success, whether that's paying off debt that you've had for years, or maybe buying back shares to give extra value to your shareholders, or investing in other aspects of your business that maybe you couldn't before. But you can't do any of that if your business operations isn't consistently generating cash. So the first thing that I do anytime I'm trying to evaluate a stock is I look at what the free cash flow yield is to give me an idea of where the cash flow of the business is and how it relates to the current stock price. So enough of my talking, let's go through some examples and I'll show you what I mean. So just real quick, I use Morningstar to get this information just because they have it in a few spots where I can just pull the number to do a quick calculation without having to calculate a bunch of different things. But you can find this information pretty much on any stock investing website, or obviously calculating it yourself if you want to do that. So on the Morningstar website, when you pull up a stock, you don't have to have a paid subscription. You can do this just with the free website that they provide. So once you go to a stock quote, go to financials, then click the cash flow tab here. And on the bottom here, what you'll see is free cash flow. So what I've created is just a really basic spreadsheet that I use to play around with. It's nothing fancy, but I'll show you what I do. And so what I'll do is I'll look at the free cash flow here on Morningstar, and I will actually enter in all four of these numbers. I'll put in the 2019 number, 2020, 2021, as well as the trailing 12 months. And then once I have that information, I will go to the valuation tab on Morningstar. And if you scroll down, there's this item here that's enterprise value. And once I have the free cash flow numbers and the enterprise value numbers in my spreadsheet, I can just do a very simple calculation to be able to get the free cash flow yield. And all I do there is I take the free cash flow and I divide it by the enterprise value. I would say anything over 10 would be really interesting. Over 7, I would look into a lot more. I talked about high growth tech stocks early on, and let's actually go through one to see what it looks like when you apply the free cash flow yield method to it. All right, so if I go to Snapchat, I'm gonna start off with the cash flow. And just right off the bat, when I look at the cash flow for the previous few years, it's only been positive in 2021 and then the trailing 12 months. I mean, usually that's not going to be a good sign, right? If you have negative cash flow, chances are your cash flow yield's just not going to be good at all. Then I'll go to valuation. enterprise value. All right, and so as you can see, when you plug in those numbers for Snap, the free cash flow yield is terrible, just because Snap as a business just isn't generating a lot of cash. And so you can see, right, if people are trying to find stocks that have more inherent value, especially if it's in times of a recession, that's why they're pulling out of tech stocks, because stocks like Snap aren't very profitable and they're burning cash and they're not generating cash. Which is a problem. Okay, so let's take a look at a little bit better one here. Let's actually look at American Express. Okay, so if I look up American Express on Morningstar, again, I'm going to go to financials, cash flow, and I have my free cash flow numbers right here. As you can see, they had a dip in the pandemic. Then I'm going to go to valuation and enterprise value. I'll take the 5-year, I'll take current, and then the last 3 years. So I plug all my numbers in for American Express. Now just take a look at what we have here. If I look at the aggregated cash flow yield, kind of like over the last few years of data, so you're talking about a 3 to 5 year average of information. It's pretty close to 7, especially if you take into account trailing 12 months. And that's actually including the lower numbers that happened in 2020 because of the pandemic. I didn't take those out. So that's actually pretty promising. And if I look at the trend of the free cash flow yield, it's actually looking really good because it's trending up. In 2019, it was a little bit over 7. 2020, again, it was down under 3, but that was a pandemic year. So if I just kind of ignore that year in general and I look at what's happened in 2021, it was over 8, which is good. And then the trailing 12 months is getting close to 10. So that is actually a really interesting trajectory that I would look at and say, American Express is generating a lot of free cash and their free cash flow yield has been increasing, especially after they got out of the pandemic. To me, this says that this is a business that's generating cash at an increasing rate, which is exactly the type of stock that I want in a recession. So as you can see, free cash flow yield can be a great tool to be able to give you a starting point in knowing which businesses are generating a lot of cash and might be undervalued with their current stock price. So as with anything as it relates to stocks, there's no silver bullet or one metric that's always going to be right. This should just be a starting point into your further research and digging into whatever stocks you're interested in. Because you can have a company that's generating a lot of cash and their stock price is relatively cheap, but it's for a different reason. They could have legal issues pending, they could have product issues. Examples like 3M come to mind. Even though I love 3M as a company, right now their stock price is kind of down. They have a lot of legal issues pending, and it's a question of whether you believe that's going to be a big deal or not. Or you could look at basically all of the tobacco companies out there right now. They're generating a lot of cash, their stock prices are down, but there's a lot of questions about the long-term viability of their products. So again, the free cash flow yield, in my opinion, is a great tool, but it's only one tool. And it should just be something that you use to get you started and then dig into companies more and more if you think it's interesting. And especially if you're like me and you're constantly trying to find really good dividend stocks to put your money into, finding companies that are consistently stacking cash is a great place to start. That's all I have for you guys today. If you have any questions about free cash flow yield or stocks in general, put them down in the comments below. If you want to watch more videos about stocks and investing, click on these videos on the end screen, and I'll see you guys in the next one. Peace.